Okay, let's move on. Let's talk about what's happening in the credit card industry. Given the thrust on digital payments, what is ICICI Bank up to? Let's welcome on board Sudipta Roy joining in right now. He's the head Unsecured Assets at ICICI Bank. Sudipta, great to have you on the show. Help us understand how the customer additions have been for you. Was there an increase post the pandemic? Our guess is must be. And how has the customer sourcing strategy really changed for you?
So obviously, if you see around the month of April and May, when we went into peak lockdown, every issuance stopped. New account sourcing stopped, as well as new account for credit cards also stopped. And frankly, whatever was being issued at that point of time was fully digital. When a customer came and opened an account digitally, or completely, or a credit card customer went and opened an instant issuance credit card, that was the only issuance that was happening during primarily those 2 months, which actually dropped to almost close to, I would say, about 10 to 15% of for the industry of the normal volumes. So that was the level of compression of issuance. However, as progressively the lockdown opening progressed, I'm happy to inform that we are seeing almost near normalcy in the month of October and November, and we are almost seeing close to our pre-COVID volumes. In fact, for us, ICICI specifically, we are seeing our pre-COVID volumes, and we are back to normal issuance. So it's business as usual for us. And with most of the industry also, it is almost back to business as usual.
Okay, so help us understand who are these new customers. If you could just share some color on the demographics.
So I wouldn't say that there has been much of a shift in demographics in terms of issuance pre-COVID and post-COVID. The same customers whom we used to target our cards at, especially customers who need to take a credit card or to pay by credit card, the same set of segments of customers that we are going and issuing. So there has not been a fundamental shift in demographics. Obviously, the pull for credit cards is far more among the lower age people than senior citizens. But it is quite widely distributed. Frankly, there has not been much change in the demographics of issuance pre-COVID or post-COVID. It is almost the same.
Right. Could you also highlight what the average spends have been and how they've changed since March?
Yeah, so there was a complete collapse in spends during the lockdown months, and only probably some essential spends where we were seeing some essential spends. However, one of the sort of fundamental aspects of the spends recovery post the gradual reopening has been that most of the categories have recovered, and some categories actually have overperformed the other categories. For example, we see far robust growth than pre-COVID levels in e-commerce, in consumer durables, in utility and bill payments. A lot of people who used to previously, do utility and bill payments before by cash have actually moved to online. The travel category remains depressed. And a restaurant, which was also very, very depressed, till the month of about August and September, actually, at least as far as ICICI Bank data, actually has recovered to about 80% of its normal pre-COVID levels. In terms of average ticket size and average spends levels, we see that there has been a slight increase in average ticket size, a 5 to 6% increase in average ticket size in credit cards. In debit cards, we haven't seen a major increase in ticket size. The ticket size has really remained the same. And one of the sort of pointers to the average increase in ticket size on credit cards is primarily the grocery ticket size have increased, and a large amount of consumer durable spends have happened. A lot of grocery shopping is actually happening online. Almost 50% of the grocery shopping is happening online. So I guess, and before pre-COVID, our total spends to online spends or e-commerce spends used to be about, depending, 45% of the total spends. Now that is upwards of 60-65%, e-commerce is of to total spends. The travel category and international spends remain depressed. However, our spends volume which was there pre-COVID, we are almost at the same level. There has been, the spends have been quite robust. We saw good spends in the month of October. We saw good spends in the month of November. And as far as spends concerned, we are back to, again, as you said, on an even keel. We are no more at a deficit. Those there are certain categories at deficit, but certain categories are overcompensating for that. So on the overall, we are, about back to whatever we were, pre-COVID levels.
Delinquency rates in credit card customers, given that you have a very large exposure to salary class and some job losses have been there, what's been your experience there?
See, as a bank, we have always been very, very conservative in terms of issuance of our products, and we adherence to the bureau tracks and CIBIL norms and extensive due diligence of the CIBIL tracks is a philosophy. So the fact is that when you have a disruption of this size, yes, obviously there can be some customers who might find some difficulty in meeting their obligations. However, it is not something that we cannot manage. Our debt service management group is completely capacitated to manage and help those customers meet their obligations. And frankly, this is something that is quite manageable for us. I cannot comment on overall for the industry, but for us, it is quite manageable.
About the use of AI, artificial intelligence, how is that benefiting you in order to understand patterns, recovery, and even the customer behavior?
Yeah, so the fact is that artificial intelligence is a big tool in terms of credit evaluation is a mix of many decisions. The credit evaluation is a mix of the customer's income, the customer's stability of income, the customer's future income outlook, the customer's previous history of discharging his obligations as represented in the bureau track. So it is a mix of many fundamental credit due diligence processes. Now, artificial intelligence sometimes, and typically what happens is that previously in a judgmental underwriting where, a credit manager or a human being used to look at all these parameters and then come to a human decision. Obviously, to speed up the process of underwriting, lenders across the world are using a lot of computer models in which some of this data which comes from the credit bureau, some of the data which the customer has declared, some of the data, which income data which the customers has submitted, all this go into a model and this model trains over a period of years. For example, the model looks back at its previous decisions and is able to auto-train itself in terms of fine-tuning the decision in terms of credit approval process with the goal of minimizing losses. Now, we also use some of these machine learning models in which some of this data goes in and it comes out with certain recommendations. However, one thing I would like to say is that, it is not that, we only trust the machines. The fact is that there are certain cases which are straight passed through. They're absolutely clear. So those no human being looks at, and those are like STP processes that goes through automatic approval. However, there are certain cases where the machine flags saying that the machine is unable to take a decision and it prefers to a human being to look at it, then a human being or a credit manager will look at it. So it's, for us, we are using machine learning models and artificial intelligence driven or models which have artificial intelligence at their core. However, there is fair set that also goes through a judgmental credit underwriting using a human being. Though we are trying to get as much data of the customer as possible as it is available, so that majority of the underwriting can be done by the machine, and the human being just does a yes no, and that process can be made very, very fast. So that is what we are right now. So yes, we are also using.
Right. I've always wanted to understand how the rewards program works. Help us understand and give us some examples, if you can, as to how is it that you partner with various brands and firms to create value for your customers?
Yeah, so the fact is that if you see our rewards program, which we call ICICI Rewards, is probably one of the most powerful rewards program in the country, because it draws on the platform of Coalition because it is operated by Payback, in which we have Payback as Coalition partners across the world, so that our customers can pool their reward points with other places where they can earn Payback points. So that is our primary rewards program. However, in many of our co-brands, the rewards program is basically the currency of the co-brand partner. For example, in our co-brand with Amazon, the rewards currency is basically the Amazon cash, or the cash that goes into your Amazon Pay account. So whatever you spend, you earn a particular percentage of your spend as reward points, and that gets seamlessly transferred into your Amazon Pay as cash at the end of every month or end of every statement cycle. So for Amazon Pay program, Amazon Pay Cash is the rewards program. For our Intermiles program, the Intermiles, which is the Spellcheck privilege program, the miles is the currency of that particular program. For our program with Make My Trip MMT Cash is the currency of the rewards of that particular program. So customer who has, who is particularly looking after a certain form of gratification will choose a product which gives him that particular reward point. And we have a huge plethora of that, and we believe that it is driven more by customer choice rather than us telling the customer which is good for them.
Want to also get your view on the surge in UPI volumes and whether or not you see that as a threat to the industry, the kind of moat perhaps that you've seen being built or surrounding credit card usage?
I personally think, the credit card industry has been growing very robustly, and I do believe that the reward points that the customer get by spending on credit cards, the credit period that the customer get by spending on credit cards, the various co-brands that the customer have on access while they spend on credit cards, as well as the various EMI propositions, right? You can buy a product and convert into EMI, provide an unbeatable value proposition to a customer who is using credit cards. In terms of UPI I think has done fabulously well. I think it is without a parallel in the world. It is that short form tutorized form of payments which customers really find very, very easy to use. And I think what UPI has done is that rather than UPI taking away share from credit or debit cards, UPI has actually expanded the market. Because what UPI allows is that a very asset-light model of payment. In a credit card or a debit card, if you have to use, you have to have a terminal. But what UPI does is actually, you have to have just a QR code to do the payment and a mobile phone for the customer who is doing the payment. So many hitherto places where probably the volumes in a particular day were probably not good enough for the economics of a particular physical POS machine to be deployed. A QR code is being deployed by in that particular place. You find a lot of places where you can actually go on your roadside and have a cup of cooler chai and actually pay by UPI QR at that particular place. Many milk vendors are actually where we previously used to collect cash are actually now collecting cash they are carrying a QR code and collecting cash, through UPI QR. So what I think UPI is essentially doing is that UPI is essentially displacing cash. I think that is exactly the mandate that it was built for. It is displacing cash, and it is taking, electronic payment to places where it might be difficult to carry a physical terminal. And so basically it has dematerialized the entire payment process into a very asset-light model. And it is taking payments to places where, such physical payments might have been difficult. So I think UPI has actually expanded the market. And what UPI actually is doing is UPI is actually cutting down the digital friction or the sort of the hesitancy to do electronic payments for customers who actually had never done electronic payments before. For many customers, a payment on UPI is probably the first electronic payment that they're doing. And once you get over the fear of doing electronic payments, these customers actually transition to actual physical payments using a debit card or a credit card. So I do believe that UPI actually is a great tool for enabling customers digital payments sort of experience to build to sort of dissipate the digital friction or the fear of making electronic payments, and then push him forwards to more advanced form of payments using credit card, where it's a different ballgame where actually you take credit and you learn to use credit responsibly. So credit card spends have actually not dropped. They have been growing at a fast clip. Debit card spends have not been dropped. They are growing at a fast clip. And UPI spends are also growing, which actually points to one thing, that India is on an inexorable journey towards a less cashless mode. And as long as this snowball keeps hurtling down the hill, all the forms of payment will grow. And cash will be the only casualty, which I think is a great way to go.
All right, Mr. Roy, we'll leave it there. Thanks so much for joining us and taking out the time today, and look forward to chatting again soon. Let's take a very quick break. We'll come back with some chartbusters on the other side.